Hello and welcome. In this lecture video, I'll be talking about the direct method for creating the operating activities section of the statement of cash flows. Remember that there's two methods, the indirect method and then the direct method, but these two methods only pertain to the operating activities section of the statement of cash flows. Financing, investing, these do not pertain to the financing, investing, and investing activities sections, only the operating activities. Okay, so if we were to go back in our course pack and we are to look at this page, cash flows from operating activities, okay, and we looked at the direct method. So the direct method does, unlike the indirect method, remember the indirect method takes net income and looks at changes to non-cash current assets, current liabilities, non-cash expenses, and then non-operating gains and losses, and then makes a series of adjustments based upon changes in account balances on non-cash current assets, current liabilities, adds back depreciation, other non-cash expenses, and adds back non-operating losses and subtracts out non-operating gains. It does those adjustments to net income to then derive net cash provided or used by operating activities. The direct method, on the other hand, says, here's how much cash we got from customers. And I know this is probably a little bit hard to read, but you can find the page in your course pack and make it a little bit bigger. So we can see cash received from customers, $570,000, cash paid for merchandise, $319,000, cash paid for wages and operating expenses, cash paid for interest, cash paid for taxes. With the direct method, we don't take net income and make changes to it to derive net cash provided by operating activities. We calculate the inflow or outflow based upon each major activity, each major item. Okay? So to do the direct method, we have a lot of fun with T accounts. All right? So T accounts are your friend when we are doing the direct method. Okay? So let's go ahead and jump into some T accounts. Okay? So the first one that we want to do, and we're going to be using our Genesis, our same comparative balance sheets and income statement here to be used to do our direct method. Okay? We'll be doing a lot of T accounts. So let's go ahead and jump into it to calculate the cash received from customers, which we saw on that page was $570,000. But let's go ahead and do the T account for that, which we did before actually in a prior lecture video, but I'll go ahead and do it again just because I'm nice. We got our beginning balance of $40,000. Where do we get that from? Our balance sheet. Accounts receivable, beginning balance $40,000, ending balance $60,000. And then remember what we talked about in that prior lecture video. What is the journal entry to record a sale on credit or a sale on account? It's debit, accounts receivable, credit sales. So this credit to sales right over here, this sales is a credit to sales, right? $590, but the corresponding debit is to accounts receivable, like what we talked about before. So I can put my $590 right over here. So I have my beginning accounts receivable, my sales, my ending accounts receivable. Now we can figure out the credit. The credit to accounts receivable, as we talked about before, relates to how much cash we received from our customers. Okay? That's how much cash we have received from our sales to our customers. That's what the credit is. And the way we figure that out, we take the $590 plus the 40 minus the 60 gives us our $570. Then we can look back over here and check our work against our direct method, and we can see right over here $570 is the cash received from customers. Okay? Now, what we want to do is see if we can't derive the cash paid for merchandise of $319. See if we can't get to that number. $319. I know it's a little difficult to read on the document camera, but you have that page in your course pack. Okay, so you can see it at 319 is cash paid for merchandise, and we're going to drive that number now. So in order to do that, I want you to look back on this page in your course pack for your balance sheets, your comparative balance sheets, and then your income statement. Okay, so to do our cash paid for merchandise, we have to do two T accounts. So I'm going to flip the page over. The first one is we have to do it for merchandise inventory. That's our first T account. And if you were to look at the balance sheet, you have beginning merchandise inventory of $70,000, and then what you have is ending merchandise inventory equal to $84,000. Now, if we think about the journal entry to record a sale in a perpetual inventory accounting system, we have two journal entries. Record the sale. Let's say the sale is on credit, so we debit accounts receivable, credit sales. And then the second journal entry, we have to recognize cost of goods sold. We have to recognize that cost of goods sold has gone up and merchandise inventory has gone down. So that journal entry is debit to cost of goods sold and credit to merchandise inventory. So if we look on the income statement, we can find cost of goods sold. And go ahead and look on the income statement on that page of your course pack, and I'll bring it up. Here's cost of goods sold. It's $300,000. So following along with the journal entry, right, we would debit cost of goods sold for $300, credit merchandise inventory for $300. So what I can do is put that right here on the credit side for the merchandise inventory. So then what we have is we have some number here that we're missing in our T account, and we can figure that out. How can we figure that out? Well, we can say 70,000 plus X minus 84,000. Okay. 70,000 plus X minus 300,000 equals 84,000. 70,000 plus X minus 300,000 equals 84,000. And when you solve for X, you get $314,000. Now, what does this $314,000 represent? Well, it's a debit to merchandise inventory, right? When do we debit merchandise inventory? When we buy it. When we buy it. So this represents purchases of merchandise inventory. Because remember the journal entry to purchase merchandise inventory. Let's say the journal entry to purchase it on credit. Debit merchandise inventory, credit accounts payable, right? That's our journal entry to purchase merchandise inventory on credit. So that still doesn't say, this is how much we purchased, but we don't know of this $314,000, how much of that we purchased using credit or how much we purchased using cash. We don't know. Well, we can use our accounts payable T account now in conjunction with this 314 to help tell us that. So we can look at our accounts payable T account. If you look back at the balance sheet on that page for Genesis, you would see we have beginning accounts payable of $40,000. And then what we have is ending accounts payable of $35,000. Now, if we look at this journal entry and relate it to over here, that 314 debit to merchandise inventory, and then we credit accounts payable. So I put the 314 on the credit side because of the journal entry. Now we have to solve for X. Now how do we solve for X? 40 plus 314 minus 345. This is 319. What does this 319 represent? Well, when do we debit an accounts payable? When we pay it off. Remember the journal entry to pay off an accounts payable is debit accounts payable, 319, credit cash, 319. If we look back on this page it says the accounts payable balances are all for merchandise inventory. So what this means is that we paid $319,000. This is the cash paid for merchandise inventory. Okay? And if we look back at our direct method, we can see 319 right there. Okay? So now let's continue on and looking at our cash paid. We talked about our cash paid for merchandise inventory. Let's look at our cash paid now for wages and other operating expenses. 218, and then cash paid for interest and cash paid for taxes. So in terms of our calculation for our cash paid for other wages and other operating expenses, we have to look at our T account for prepaid. And if you look at the balance sheet, you find the prepaid expenses, $4,000, and then $6,000 right there. So remember, I have my $4,000 beginning, I have my $6,000 ending, and then what I have is, if I look at my income statement, I have this wages and other operating expenses right there, 216 from my income statement, 216. Okay, so I'm going to put that over here on the credit side, and I'm going to explain that now. The journal entry, if we think about the journal entry to recognize that prepaid rent has expired. Well, let me back up. Let's think about the journal entry to purchase prepaid rent. So what we would do is go prepaid, debit prepaid rent, credit cash, right? And then what we would do to recognize that prepaid rent has expired, we would go rent expense, debit rent expense, and then we would credit prepaid rent. So if we think about all of this as just prepaid rent, right? This 216, wages and other operating expenses, we could just think of that for a second here as rent expense. So prepaid rent that has expired and now is rent expense. So we have that rent expense of 218, the credit, of 216, prepaid rent 216. So that comes over here. Now we can solve for X. How do we solve for X? 4,000 plus X minus 216 equals 6,000. And when you do the math, you get 218 is equal to our unknown. Now, what does that equal? Well, when do we purchase any prepaid? When we buy it. So this debit over here is there, and then the credit goes to cash. So this is how much cash we paid for our wages and other operating expenses, which you can see right there of 218. Okay? Let's walk through our interest, our same problem for interest expense and income taxes expense. So with interest expense, I'll look at my interest payable. Okay? So I have my beginning of 4,000. And then if I look at my interest expense, I had 7,000 from the income statement, 3,000 ending. That means I have $8,000. This is my cash paid for interest. Okay. And then I could do something similar over here. Now, again, why is this? Because why do I put this $7,000 here? Because the journal entry to recognize interest expense or to accrue interest expense, debit interest expense, credit interest payable. The same thing applies for income taxes. So I have my taxes over here. I have my beginning of 12,000. And if you looked on the income statement, you had tax expense of 15,000. And then you had ending over here of 22,000. That means the unknown right here is equal to 5,000. This is the taxes paid. This is the interest paid. Interest paid, taxes paid. And thank you.